Hello there, welcome to Finance Teacher. In this video, we will discuss the mechanics of a structured product called the decumulator. A decumulator is pretty much the opposite of an accumulator discussed in a separate video. Let's get going. Now, what is a decumulator? It is a structured product where the investor has the right and the obligation to sell a specified asset at a specified price called the strike price to the issuer in a specified quantity per observation period, for example per day, for a specified number of days. There could be a gearing feature that increases the number of assets to be sold by the investor if the asset price goes above the strike price. There could be a knockout feature that terminates the product, or a barrier level that temporarily stops the decumulation if the asset price goes below that level. Investor's profit is strike minus average purchase price into units sold. Issuer's profit is average selling price minus strike into units bought. Say an investor agrees to sell 1,000 shares per day of XYZ Corporation over 90 days at $11 per share to the issuer when the market price of the share is $10 per share. Now, this makes sense because the investor is able to sell at a higher price than the market. It's especially attractive if one is bearish about the share. However, since all rewards come with risks, the decumulator has a catch. The investor remains committed to selling 1,000 shares every day for 90 days, even if the share price rises much above $11. In that case, the investor will be selling shares at a discount to the market price. He cannot say no because he is obliged to sell the shares. In an extreme scenario where the share price increases significantly, say to $15, the investor may end up foregoing a lot of potential profits or incurring tremendous losses. There is no limit to the loss that the investor may incur. For example, if he already owns the stock, he will forego profits by selling shares to the issuer instead of in the market. If he does not own the shares already, he will have to buy the shares from the market at a much higher price and sell them to the issuer at the strike price, which would be lower in that scenario. Banks or the issuer may require the investor to already own the maximum possible shares at the outset, the maximum possible that the investor is required to sell to the bank during the tenure of the decumulator. And what about the issuer? The issuer also takes the risk of buying shares from the investor at a higher price than the market price. For example, if the share price stays at $10 for all the 90 days, the issuer will end up buying 90,000 shares from the investor at $11 when it could have bought the shares at $10 from the market. What if the share price crashes to 7? In that case, the issuer will lose thousands of dollars. However, to save the issuer from such a mishap, the decumulators put a knockout barrier, for example at $9, at or below which the contract terminates. That is, if on any day the barrier level is touched, the decumulator will get knocked out. For example, if the share price touches $8.90 on day 20, the whole contract will be settled for the 19 days and both the parties will go home. The product will get terminated on day 20. Therefore, the issuer's loss gets limited. Alternatively, the terms of the decumulator may be such that if the barrier level is touched, there will be no decumulation on that day, but the product will remain alive and the investor may get to sell more shares to the issuer when the price rises to above $9, which is the barrier level. The settlement schedule may vary. For example, the asset price may be observed daily and the assets may be delivered to the issuer on a monthly basis. Based on the number of days the shares remains above the KO barrier level. Also, there could be a super risky decumulator where the investor is obliged to sell 2 times the number of shares if the asset price rises above the strike price. This is called a step-up feature or a gearing feature. For example, a 2 times gearing decumulator may require the investor to sell 2,000 shares per day on which the share price is above $11, else the investor must sell only 1,000 shares per day to the issuer, subject to the KO or the barrier condition. Let's look at the terms of a decumulator. The main terms to look out for in a decumulator product are as follows: the strike price at which the investor sells the underlying, the observation period, which could be daily or weekly, the number of units of the asset, for example the shares, to be sold per observation period, for example per day, the settlement frequency, that is monthly or quarterly, and the knockout barrier below which either the decumulation will temporarily stop or the product will get terminated. Let's look at the suitability of the decumulator. Well, it is obvious that the decumulator is suitable for an investor who is bearish on the underlying price. At the least, he expects the underlying price to remain below the strike price so that he can make a profit. The investor must own the required number of units of the asset at the outset to ensure profits or limit his losses, although he may lose potential profits. For example, if the strike price is $10 and the investor already has shares purchased at $9, he can be sure of getting $10 for his shares. Moreover, decumulators are for risk takers, not risk-averse investors, because the loss potential is significant, theoretically unlimited. Let's look at the derivative components of a decumulator. One way to look at it is that the investor enters into a series of forward contracts to sell the underlying at the strike price to the issuer, whatever the market price, subject to the KO or the barrier condition. Another way to look at it is that the investor is long a series of put options on the underlying asset that allows him to sell the underlying asset if the price of the underlying asset is at or below the strike price. Simultaneously, the investor is also short a series of call options that obliges him to sell the underlying asset to the issuer if the underlying asset price is higher than the strike price. The put purchases are financed by the sale of calls. Let's discuss an example to understand decumulators. We'll take up an equity decumulator. Reference shares is XYZ Limited. Observation period is 3 months or 90 days. The initial market price at the time of entering into the contract is $20. The strike price is $22. The KO barrier is $18. And the number of shares per daily observation is 20,000. And settlement is done every 30 days. There is a gearing of 1.5 times. As you may note, the decumulator has a KO barrier which can terminate the contract. The 1.5 times gearing implies that if the market price of the underlying share is below the strike price of $22, the investor is obliged to sell 20,000 shares of XYZ Limited to the issuer at $22. However, for every day that the share price is above the strike price, the investor will have to sell 1.5 into 20,000, which is equal to 30,000 shares to the issuer at the strike price of 22. The KO barrier of 18 means that if the share price touches 18 or goes below that on any day, the contract will get terminated. Let's consider scenario 1, where the average cost of shares for the investor, the purchase cost, is $20.5. The XYZ shares are above $18 and below 22 for all the 90 days. The closing price of XYZ shares is $21. Note that the closing price of the share is irrelevant when we calculate the profit and loss. What matters is the average cost of shares purchased by the investor. And since XYZ shares are above $18 and below 22 for all the 90 days, this means that neither the gearing nor the KO barrier will come into play. In this case, the investor will sell 20,000 into 90, which is 1.8 million shares of XYZ to the issuer, and he will receive 1.8 million into $22, which is the strike price, which is equal to $39.6 million for the shares from the issuer. The exact profit and loss of the investor will depend on the average cost at which he purchased the share. If the shares were purchased at an average of $20.5 per share, the profit will be $22 minus $20.5 into 1.8 million, which is $2.7 million. $22 is the strike price at which the shares were sold, and $20.5 is the average price at which the shares were purchased by the investor. The percentage gain will be $2.7 million divided by 1.8 million into $20.50. The denominator is the purchase value for the investor, which is equal to $2.7 million divided by $36.9 million, which is 7.32%. You can also calculate the percentage gain as $22 minus $20.5 divided by $20.5, which is again 7.32%. Let's look at scenario 2. Here the average cost of purchase of shares for the investor is $19. XYZ shares are above 18 and below 22 for the first 35 days. On day 36, the closing price of the shares is $17.5. Now this indicates that the decumulator product will get knocked out on day 36 because the underlying share price moves below $18, which is the barrier level. In this scenario, the investor will decumulate 20,000 into 35, which is equal to 700,000 shares of XYZ Limited. and he will sell these shares to the issuer at the strike price of $22. On day 36, the product will get knocked out, the contract will terminate, and the settlement will be done. The investor will receive $700,000 into $22, which is $15.4 million from the issuer. The investor's profit will depend on the average purchase price. If we take the purchase price as $19, the investor's profit will be $700,000 into $22 minus 19, which is $2.1 million. Based on an investment of $700,000 into $19, which is $13.3 million, this is the purchase value for the investor, the percentage profit will be $15.4 million minus $13.3 million divided by $13.3 million, which is $2.1 million divided by $13.3 million, which is 15.79%. The percentage gain can also be calculated as $22 minus $19 divided by 19, which is again 15.78%. Let's look at scenario 3. Here the reference share price average cost for the investor is $23. The XYZ shares are above $18 and below $22 for the first 35 days. From day 36 to day 90, the closing price of the shares is greater than $22. This basically means that the product does not get knocked out. It stays alive for the 90 days because the price of XYZ shares never moved at or below $18. And for the first 35 days, the decumulation will be 20,000 shares per day. Thereafter, the gearing will come into play and the investor will have to sell 30,000 shares per day to the issuer. Therefore, the investor will decumulate 20,000 shares per day for 35 days and 1.5 into 20,000, which is equal to 30,000 shares for the balance 90 minus 35, which is equal to 55 days. Therefore, the total sales by the investor to the issuer is 20,000 into 35 plus 1.5 into 20,000 into 90 minus 35, total of 2.35 million shares of XYZ. In return, the investor will receive 2.35 million into $22, which is the strike price, a total of $51.7 million from the issuer. The investor's loss will be 2.35 million into $22 minus $23, which is the average cost of the shares purchased by the investor. Therefore, the investor will lose $2.35 million. On an investment of 2.35 million into $23, which is 54.05 million, the percentage loss will be 51.7 million, which is the amount the investor receives from the issuer, minus 54.05 million, which is the investment amount, divided by 54.05 million, a loss of 4.35%. This loss can also be calculated as $22 minus $23 divided by $23, which is minus 4.35%. Let's look at the risks of decumulators. First and foremost, there is a risk of significant loss because there is no capital preservation feature. The gearing may magnify losses. There could be breakage costs for premature termination. There could be an uncertainty about the buying price of the shares in case the investor doesn't already have those shares. The KO barrier will limit the potential profit of the investor by either stopping the decumulation or terminating the contract. This ends our video on decumulators. Please like the video and subscribe to our channel to support us. If you have any questions or comments, please write in the comment section or email us at wiseatfinance@gmail.com. Happy learning.